Right, I think we are there. It's 11 o'clock. So good morning, everybody, and thanks for tuning in again. So we've got a bit of news to run through before we talk to Anna Gould of Patria Private Equity. News first. So I picked out 4 stories from this week. I'm going to start with VH Global Energy Infrastructure, where, as you can see, is in the normal pattern with the renewable energy sector. We've seen quite a big widening of the discount over the past sort of couple of years. And that's left it trading on a bigger yield, which I suppose is helpful, but nevertheless, people are a bit fed up. So the manager decided, or the board decided, to talk to shareholders, and the feedback wasn't great. So basically, only a minority of investors wanted to keep it going. So they're now proposing a managed realization process for the assets, and then obviously that needs shareholder approval if it's going to happen. So they've got quite a few reasonably mature assets which are going to be quite easy to sell. It is possible that somebody would buy it into a portfolio, but I think that's very unlikely, and I think they do too. They kind of acknowledge that part of the issue is the diverse nature of it. In the meantime, they're going to keep paying quarterly dividends, but obviously as they sell assets, the income to fund those goes, so that might fall over time. They think they can actually get the whole portfolio realised within 3 years, and they're actually saying that we think we can get a reasonable result for shareholders, even for those that paid £1 for the shares. So the existing manager will do the job of realisation with some new fee arrangements. So the proposals, okay, so the existing fees you've got there, sort of a tiered fee, there's 412 million of net assets at the moment. So that works out at 3.958 million, I think, by my calculation. They're actually proposing a higher base fee. Now, I was quite surprised by this, but the argument is it's sort of the manager's going to have to sort of work quite hard to get it all realised because they're going to do it in a shorter time frame than it took to get it invested. I'm not completely convinced by that, to be honest, but nevertheless, that is the proposal. But obviously, on top of that, there's a performance fee based on how much they hand back to investors. And again, I think this isn't particularly ambitious. So it's complicated too, and not completely clear what's going on here. Basically, the faster they get the money back, the lower the fee, the lower the NAV reference amount can be. So if they hand back 90% of the money in year 1, then there's sort of 5% available to cover a performance fee, and then they get a percentage of that, and then those percentages change over time. So you'll see there that if they sold the whole thing for asset value, they'd actually get 20% of all the returns. If they sold the whole thing for asset value in year 1, they get 15% of all returns above 85%. I just think this is a particularly challenging hurdle, but there we go. This is what they put forward. The board's tried to justify this, and there's some words around that there. And also, it seems that shareholders are quite frustrated, and so therefore prepared to take a haircut to get the cash back. As I say, I'm not completely convinced that this is the right incentive structure. Third Point Investors, which has also been trading on a big discount for quite a long time, as you can see there, has come up with a slightly odd proposal. So it's saying we want to merge with a reinsurance company that another partner of Third Point owns at the moment, which would effectively increase the Third Point stake within the fund, diluting down the external investors. This is a business that they want to grow quite quickly to about $5 billion annual premiums by 2027, and the capital for that is going to come from the existing fund. And so basically, they've got a portfolio of assets now within the Third Point Opportunities trust, as they're going to sell those. So we're going to redeem assets from that to fund the expansion of the master fund portfolio. And they want to transition that business to a pure play insurance business within about 3 years. They've got a guy running this business already, so he will be CEO of the combined company. So this will stop being a fund and become really just a quoted reinsurance company. And they reckon they can make mid-teens return on equities on it, and actually we end up being valued at premium to book, premium to NAV, which would obviously be great given where we are. However, that's a big departure from what it's doing now. It's understandable that some shareholders will want to exit. They're proposing a tender offer of $75 million. But the problem with it is that they're proposing to do that at a 12.5% discount. And I just don't think that's on, really, because this is a complete change of strategy, complete change of risk profile. I think it's reasonable that the people who want to get out should be able to get out. Strangely, Saba is on the register. It was quite small, only 1.2%, but they've actually been to talk to them and got an agreement for them to support it. But AVI owns 7.1%, and they are very much against the proposal. So I've given you here the whole text of what AVI have said. It's really quite damning. I'll let you sort of read it in your own time. Basically, they're saying, yeah, you're just aping what other people have done before. You're really coming late to the party on this. It's all very well to say it's going to be trading at NAV and make sort of high returns. I don't think there's any guarantees of this. They think that the whole thing is conflicted in the way that the people who are recommending the transaction will actually end up being involved in the new business. And they don't even think the broker is entirely impartial either. And so they're urging people to vote against the proposal. And then there's a debate then also about whether the third point should be allowed to vote in stock or not. So I think this sort of row is going to run for a bit yet, and we'll see what happens. I wouldn't be surprised if it goes through, but nevertheless, shareholders are going to be quite unhappy about it. I would vote against, I think, and I'm looking at all of this. I just feel that because it's such a complete change of strategy, you should be able to get out at NAV. Riverstone Energy next, another big discount that's persisted for a very long time, but they have been slowly shrinking it. So the market cap's now down to 200 million. It's stuck on this big discount, which is unfortunate. And the board and the manager have decided it's now time to wind the fund down. Obviously, that needs shareholder approval. And the manager is saying, well, we will do this for a lower management fee of 1%, down from 1.5%, which all sounds great so far. But, and this is a big but, they also want to get the termination payment that they would have got if somebody had come from outside and beaten the thing up and fired the manager and tried to take it over. So I just don't think this is on. It's really quite greedy. 7.5%. So basically what they're saying is straight away, as soon as people approve this deal, they get 7.5% of all the assets apart from the unquoted stuff. Then the unquoted stuff will be turned into cash over time, and then they get 7.5% of that. And if you said they do an NAV, that's $21 million. I just don't think that's right. And I understand why you want to be protected if somebody attacked you from outside, but if you're the person who's putting your hand up and saying, we want to wind it up, I don't really think you should be entitled to this. But again, I very much doubt whether shareholders will be able to do anything about it. Then lastly, JPMorgan Indian, you can see there another chart where the discount's been quite wide for a very long time, and it sort of suddenly comes in at the end there. In fact, it's going to even higher than the band there. That's unfortunate. Morningstar has displayed that. So JPMorgan Indian hasn't been working for a long time. We've talked about this before. It had a performance-linked tender planned for later this year based on what happened over the 5 years to end of September 25. They're going to scrap that and instead slightly earlier than that, that would have happened. They're going to do a 30% tender at more or less NAV. And then after that's complete, they're going to buy back stock to drive the discount down to single digits. Now, obviously, that discount's already moved, so they might not have to buy back very much, but that measure will be in there to sort of protect shareholders going forward. And then they're talking about doing another tender offer in 2028 for 100% of the fund at a 3% discount. So basically, you get the chance to get out 30% of stock this year, and then 3 years' time, you can exit the whole thing. And they're saying if the whole thing dropped below £150 million, they will probably just do a wind up. So there's a continuation vote in 2029 anyway. Really, from a sort of trying to balance demand with the story, I think this will kind of make sense, and it probably should be applauded. To try and encourage investors to stick around, one of the things that they're changing is to introduce a much higher yield. So that would be 4% of NAV paid quarterly. And they're also lowering the investment management fee, so that actually boosts the income anyway. But nevertheless, the 4% NAV is regardless of how much income they've got. But yes, yeah, so all good news. Tick, tick, tick. We like all that. The problem is, though, and the reason why investors are agitated and the reason why investors want something like this to happen is because of the performance. And none of those measures we've talked about are designed to change the way the fund is run. And you can see there that is quite a long way behind the peer group, especially over 10 years. So the big question really is anything going to change? And if nothing changes, then I would expect that everybody would really want to get out, and they'd rather get out now, sooner rather than later. So whether this actually satisfies people or not, I don't know. I might be being a bit mean here, but it does feel to me as though they could have been more aggressive. So that is enough from me.